A day of infamy. The biggest crash in history, October 29, 2029. This date is now synonymous with financial disaster. This date will forever be etched in the annals of financial history. It marked a turning point, a moment when the world stood still and watched in horror. It was the day the world witnessed the biggest single-day stock market crash ever recorded. The chaos on the trading floors was unlike anything seen before. Trillions of dollars vanished into thin air. Panic gripped investors worldwide. The financial landscape was irrevocably altered. The very foundations of the global economy seemed to crumble. Businesses shuttered and economies teetered on the brink of collapse. The crash was of an unprecedented magnitude, dwarfing even the infamous Black Tuesday of 1929. Comparisons were inevitable, but this was a new beast. Major stock indices plummeted by double digits, with the Dow Jones Industrial Average experiencing its largest percentage drop in history. The numbers were staggering. The speed and ferocity of the decline left analysts and economists stunned. Predictions and models failed to capture the sheer scale of the disaster. The crash sent shockwaves across the globe, impacting businesses, investors, and ordinary citizens alike. No corner of the world was left untouched. It served as a stark reminder of the interconnectedness of the global financial system and the potential for systemic risks to materialize with terrifying speed. The lessons learned from this event will echo through history. The gathering storm. Seeds of a financial crisis. The roots of this catastrophic crash could be traced back to a confluence of factors that had been brewing for years. These factors were not isolated incidents, but interconnected events that created a perfect storm. Excessively loose monetary policy had fueled an unsustainable bubble in asset prices. The Federal Reserve's decisions to keep interest rates low for an extended period played a significant role in this. Low interest rates and easy access to credit encouraged reckless speculation and excessive risk-taking. Consumers and investors alike were drawn into a cycle of borrowing and spending beyond their means. Deregulation in the financial industry had created a breeding ground for complex and opaque financial instruments. These changes in regulations allowed financial institutions to engage in riskier behaviors without adequate oversight. These instruments, often poorly understood and inadequately regulated, magnified systemic risk within the financial system. The lack of transparency made it difficult for even seasoned professionals to grasp the full extent of the risks involved. Adding fuel to the fire was a growing disconnect between the real economy and the financial markets. This divergence meant that while financial markets appeared healthy, the underlying economic fundamentals were weak. While stock markets soared to new heights, wages stagnated, and income inequality widened. This disparity created social and economic tensions that further destabilized the system. This divergence created a fragile economic landscape ripe for a correction. The bubble was bound to burst, leading to widespread financial turmoil and economic hardship. Shockwaves. Global markets reel from the crash. The impact of the crash was immediate and far-reaching. As news of the plummeting U.S. markets spread, panic selling gripped financial centers across the globe. Asian markets were the first to react, with major indices in Tokyo, Hong Kong, and Shanghai experiencing record declines. European markets followed suit, with London, Frankfurt, and Paris all succumbing to the selling pressure. The interconnected nature of global finance meant that the crash in one market quickly cascaded into others, creating a domino effect that spared no corner of the world. Emerging markets, often seen as riskier investments, were hit particularly hard. Currencies tumbled, capital fled, and economies that had been experiencing rapid growth suddenly faced the prospect of recession. Flight to safety. Bonds surge as investors seek refuge. Amidst the market turmoil, investors desperately sought safe havens for their capital. Traditional safe haven assets, such as U.S. Treasury bonds and gold, experienced a surge in demand, pushing their prices sharply higher. The yield on the 10-year U.S. Treasury note, a key benchmark for global interest rates, plummeted to record lows as investors piled into the perceived safety of U.S. government debt. This flight to safety reflected a deep-seated fear among investors about the stability of the financial system. The bond market's reaction to the crash highlighted the interconnectedness of different asset classes and the role of safe haven assets in times of market stress.
Section 5. Whispers and rumors, settlements, penalties, and uncertainty. In the aftermath of the crash, rumors and speculation ran rampant. Whispers of major financial institutions on the brink of collapse circulated through the markets. The quietness from the banking sector only added to the uncertainty and fear. Some market participants pointed to large, undisclosed settlements and potential penalties being levied against major banks as a contributing factor to the crash. The lack of transparency fueled speculation and eroded confidence in the financial system. The absence of clear information from regulators and policymakers only exacerbated the situation. Investors and the public alike were left in the dark, unsure of the true extent of the damage or the potential consequences.
Section 6. The calm before the storm, eerie silence in the banking sector. One of the most unsettling aspects of the crash was the eerie silence emanating from the banking sector. This silence was not just a lack of noise, but a profound absence of the usual hustle and bustle that characterizes financial institutions. Major banks, typically vocal during times of market stress, remained unusually quiet. Their silence was deafening, creating an atmosphere of uncertainty and fear. This silence was interpreted by some as a sign that the situation was even worse than it appeared. Analysts and investors speculated that the banks were hiding something, perhaps the true extent of their losses or the precarious state of their balance sheets. The lack of communication from banks fueled speculation that they were hoarding liquidity, unwilling to lend to each other or to their customers. This behavior suggested a deep mistrust within the banking community, a fear that any loan could lead to further losses. This credit freeze, if true, would have devastating consequences for the real economy, as businesses rely on credit to finance their operations. Without access to credit, many businesses would struggle to pay their bills, meet payroll, or invest in growth. The banking sector's silence stood in stark contrast to the panic and fear gripping the rest of the financial system, creating a sense of unease and foreboding. The contrast between the silent banks and the chaotic markets was striking, highlighting the depth of the crisis.
Financial experts Mark Z and Jeff Rahm weighed in on the crash, offering their insights and analysis.
Mark Z, known for his focus on the global monetary system, emphasized the role of excessive debt and the potential for a sovereign debt crisis.
Rahm, a renowned market analyst, highlighted the disconnect between the financial markets and the real economy, arguing that the crash was a long overdue correction to unsustainable asset valuations.
Both experts agreed that the crash would have profound and long-lasting consequences for the global economy. They urged investors to brace for continued volatility and uncertainty. E-mini S&P 500 futures, a popular derivative contract used by traders to speculate on the direction of the stock market, provided a real-time glimpse into market sentiment during the crash. The futures contracts plummeted in value, reflecting the extreme pessimism and fear gripping investors. The steep decline in E-mini futures indicated that traders expected the stock market sell-off to continue. The futures market's reaction underscored the severity of the situation and the potential for further losses. The use of derivatives, such as E-mini futures, to speculate on market movements highlighted the role of leverage and complexity in modern finance, and the potential for such instruments to amplify both gains and losses.
The biggest market crash in history will undoubtedly have profound and long-lasting implications for the global economy. Governments and central banks will be forced to rethink monetary policy, regulation, and the very structure of the financial system. The crash served as a stark reminder of the importance of financial literacy, risk management, and the dangers of excessive speculation. It also highlighted the need for greater transparency and accountability in the financial industry. The road to recovery will be long and arduous, but it will also present an opportunity to build a more resilient and sustainable financial system for the future.
The biggest market crash in history marked the beginning of a new era of financial volatility. Investors and policymakers alike must adapt to a world where sudden and dramatic market swings become the norm. Understanding the underlying causes of the crash, learning from its mistakes, and embracing a more prudent and sustainable approach to finance will be essential for navigating the challenges ahead. The future of the global economy hinges on our ability to learn from the past, adapt to the present, and build a more resilient and equitable financial system for all.